Welcome to my channel where I talk about stocks that are interesting. And if that's interesting to you, then please consider liking this video and subscribing to the channel so you can see more. Today, we're going to be talking about CME Group Inc., ticker CME, Chicago Mercantile Exchange. Large cap company, $82 billion market cap. Probably one that you've heard of before. Lately, I've been on a string of talking about somewhat obscure companies. If this company is obscure to you, it should not be, because it is very, very interesting. Very, very interesting. Okay. So, as always, we're going to give an overview of the company. I'm going to talk about the moat, if there is or isn't one, competitive advantages they have, rather. I'm going to be talking about the financials. We're going to analyze that, the valuation, the dividend metrics. We're going to discuss some of the risks of investing in this. We're going to give it a grade, buy, sell, or hold. And we're going to, as always, conclude with our technical analysis. Okay, so without further ado, let's get into it. CME Group. Okay. CME Group, together with its subsidiaries, operates contract markets for the trading of futures and options on futures contracts worldwide. It offers futures and options products based on interest rates, equity indexes, foreign exchange, agricultural commodities, energy, and metals, as well as fixed income foreign currency trading services. The company also provides clearinghouse services, including clearing, settling, and guaranteeing futures and options contracts, and cleared swaps products traded through its exchanges. It serves professional traders, financial institutions, institutional individual investors, corporations, manufacturers, producers, blah, blah, blah. The company was formerly known as Chicago Mercantile Exchange Holdings, Inc., changed its name to CME Group Incorporated. I've been to the headquarters. The river is there. Next to the headquarters, you want to invest in asset light toll booth businesses. Well, that's what financial exchanges are. They benefit from network effects. They make fees with every transaction. They are very, very scalable, highly profitable in theory, and the perfect definition of a toll booth business. I find what they do to be particularly interesting because the volumes of derivative products have been going up quite a bit. There's lots of momentum there. You see the volumes of options, futures, and whatnot that are being traded today. There's tailwinds there. It's very easy to understand. Okay. So you could actually, utilize these products the way that they are intended, to hedge or to speculate on market moves. You could also invest in shares of the exchange and benefit from the house making money. That's kind of the idea behind owning something like this. We actually see here, according to the Seeking Alpha Quant, CME is ranked as the number one by quant rating, the number one financial exchange. I do own shares of CME, excuse me. It is the only exchange that I own. The primary reason for that being that it has very appealing income return characteristics, which we'll talk about. So, does this company have a moat? Well, of course. Of course. Again, we're going to lean on Morningstar, given that they are the creator of the moat concept. It is trademarked. If I'm using moat incorrectly, please don't sue me. I'm referring to your own materials. Okay. What is the competitive advantage? Well, according to Michael Miller, the equity analyst at Morningstar covering CME, has a wide moat. Let's just refer to his analysis here. CME Group has achieved a wide moat rating as a result of its position as a leading venue for trading U.S. futures contracts. Here we go. More than 95% of U.S. interest rate futures trade on CME's exchange. The company has exclusive licenses to issue futures contracts on the S&P 500, Russell 2000, and NASDAQ indices, and it is the dominant venue for trading West Texas Intermediate oil futures. We see these strong competitive advantages allowing CME to earn excess returns on capital. CME's position in the futures market has proved durable as attempts by other exchanges to enter the interest rate futures market failed to gain traction. This is because competition among futures exchanges is largely dependent on implicit trading costs and collateral efficiencies, not the transaction fees the exchanges charge themselves. For example, the minimum tick size for CME 10-year Treasury futures contracts is $15.62.5 per contract compared with transaction fees that range from 30 cents to 75 cents. Even if another exchange charges fees less than CME, a one tick size worse execution on even a fraction of contracts would wipe out any savings to the customer from lower fees. This gives CME considerable pricing power and has allowed the firm to enjoy an operating margin that's historically been around 60%. The ability to trade on an exchange efficiently is dependent on the amount of liquidity present on the exchange already. This creates powerful network effects as the number of traders that already utilize the exchange ensures that its contracts have good liquidity, increasing their value. In other words, there's counterparty risk in futures contracts. The more liquid the exchange is, the better it is for the customer, the more pricing power it creates. Clearly, the fact that 95% of US interest rate futures trade on the exchange is a strong competitive advantage through that network effect. Here's what's interesting about that too. This is me, giving my own personal thoughts on this. 95% of interest rate futures. Think about interest rates. Interest rates have been a very, very, very hot button topic. Okay. There's probably more interest in interest rates, no pun intended, today than at any point in the last 20 years, 30, 40 years even. Seems like a pretty sexy way to benefit from interest rate volatility instead of just speculating on like bonds or even buying the futures themselves. To further aid what I'm saying, let's just take a look at their most recent investor presentation. This is dated December 5th, 2024. Here are all of the products, or at least the underlying commodities or assets that their products are attached to. So we have equity indices, foreign exchange pairs, precious metals, industrial metals, agricultural commodities, interest rates, energy, average daily volume, ADV. Very important to this business, very important to these numbers. Okay. Interest rate volumes, 36% year over year increase. Equity index, 17%. Energy, 21%. Agricultural commodities, 13%. Forex, 16%. Metals, 38%. 27% higher volumes year over year. Wow. That translated to an 18% revenue growth. You see what's going on there. They're actually charging slightly lower prices. If they have such strong network effects, aren't they able to charge higher margins on each, consecutive transaction? Not necessarily. We're going to talk about that later. 18% revenue growth, very good, at 69.1% operating margin, not gross margin, operating margin. That's phenomenal. It should not take a lot of capital to run a exchange because you think about what it is. It's computers, right? It's computers, computational power. Obviously, there's lots of employees, right? But the back end of what's going on, computation. That may be oversimplified, but that makes sense to me. 19% earnings growth year over year, 4.7% dividend yield. What is the 10-year treasury? That's higher than the 10-year treasury. What's going on? Find me numbers like this elsewhere. I dare you. Right? Doesn't that imply that it's very, very inexpensive to own if the yield is that high and our growth and our margins are that good? What is going on? Okay. So here's our annual net income here in billions. Their volumes have grown by 7% per year. Their net income has grown by 12%. That is really good. The important piece is that options volume has increased 9% from record 2023 levels. New products grown by 52% over this time frame. There's a lot to unpack here. This is kind of a graphical representation of what I was speaking to a moment ago with interest rate volatility. Historically, dispersion of opinions and forward Fed rate expectations has generally led to higher interest rate futures and options volumes. Okay. So this, I don't know what you call this color spectrum here, Fed expectation intensity. I think what that means is the more orange it is, the lower the band is for a, like the higher spread there is here, the more of a wide band there is in forward Fed rate expectations. So the fact that there's such a wide spread in expectations between the lowest amount and the highest amount, what they're saying is that drives higher volumes for futures and options, which honestly is common sense. I think that makes perfect sense. This chart here, change in implied Fed rate expectation. Oh, okay. CME Group Treasury volume. So we see here very, very strong growth. Physical commodities products, 16% growth in revenue year over year in commodities. Because there's all of these transactions, there's also exchanges might also sell data, right? Data revenue, 6% compound annual growth rate. And then because it is an exchange, they're able to generate interest income. CME Group's portion of income generated from customer cash balances held on deposit, as well as income on investing corporate fund. So this is great. How about this? How they add this? So 5.6 billion, or excuse me, 4.6 billion in transaction fees, data, other, 5.6 billion in revenue, 66.9% operating margin. Here's the deal with capital return. Earlier they said 4.7% yield. So there's two components of the dividend. There's the regular quarterly dividend, this dark blue here, which they are consistently raising. And then the annual variable dividend. Notice how it's not going up in a straight line to up and to the right. The total dividend, the regular quarterly dividend is, and then this annual dividend has also been very strong. So they, their policies to distribute 50 to 60% of earnings via this regular dividend, then repurchase shares, and then pay the variable dividend after that. So this business, obviously, okay, you look at this, there's a lot. If you're a finance person, there's a lot of sophistication here to unravel that maybe you're capable of doing. However, I think if you're not a finance person, this business is fairly easy to understand still, because it's literally just the house where futures and options are being traded and there's transaction volumes. So if you believe in the long-term viability of transaction volumes going up, then you should feel comfortable with this type of asset. One thing that's great about this type of business is you think about where do I go here to demonstrate this? So you think about this average daily volume, right? So what drives daily volume? Well, daily volumes are driven by the number of contracts, but also the price of those contracts, and the price of those contracts, depending on what type of contract it is, scale in proportion to the price of the asset, right? Potentially. So in other words, if inflation is constant, the price of all assets goes up in line with inflation and more contracts are traded. There's multiple growth drivers there. Obviously, that's oversimplified, but you get the idea. You see why this should be a fairly simple to understand business. I think it was right here. So earlier I was talking about shouldn't they be making higher margins on higher volumes? Well, not necessarily. And they kind of articulate that here. Their pricing philosophy seeks to avoid impacting the amount of volume and liquidity. It's a network-based business. Higher volumes benefits both customers and the exchange. Pricing increases are very tactical and consider a number of factors, including market and customer health, trading behaviors, and the cost of replicating the exposure through alternative means. So they're competing with all sorts of hedging instruments, right? In the pricing or spread amongst pricing there. Historically, pricing adjustments have had a 1.5 to 2 point impact. 2023 adjustments were a bit outsized. The 2023 adjustments were estimated to increase revenue by 4.5%. So every time they adjust fees, they do so with the intention of increasing total revenues by low single digits. So you see pricing goes up and down. And basically what they're saying is that they might change the pricing downwards if they believe that it will increase revenue. Obviously, there's some sophisticated math, some algorithms going behind that. That's more of an interesting data point than something to maybe be front running for a not super sophisticated guy like me, but super interesting. Income statement, 3 billion to 5.6. Notice how gross profits are higher than revenues. That's because of the latent cash sitting on the exchange. So they get paid to, at least however they, whether it's a gap thing or whatnot, they basically have a 100% gross margin. Okay. Very important. Very strong gross margins. So that's why they report their operating margins, not their gross margins. 1.8 billion of operating income to 3.9 billion. So that does imply that their operating margins have gone up over time. Interest and investment income. Well, we see here how the company has benefit from higher interest rates, just in terms of their cash position. Maybe we'll see that when we look at their balance sheet. So earnings from continuing operations have increased by more than 3 times in that time. Shares have gone up over time, but we see now that their capital allocation strategy has changed. They will now begin buying back shares. Diluted earnings per share been very strong, 335 to 951. It's almost 3 times. Payout ratio. So here's the thing with the payout ratio. You see how it hovers around 100%. So that's what's going on here with our dividend is they pay out 50 to 60% via this regular. They essentially return all cash to shareholders. They don't need to take money and invest it to scale. They just need more volumes, right? The network effect is strong. So this stock should appeal primarily to income investors who want strong yields that are growing pretty rapidly. Okay. So that's a pretty good looking income statement. The balance sheet. So we see here 1.4 billion of cash to 2.4 billion of cash. This, I think, is the see here how our current assets almost match our current liabilities. We do have, in any given period, roughly a little bit less than $1 billion more, a little bit more, hovering around $1 billion more of current liabilities over our current assets. So that's just basically like the client cash or the contracts that it's holding on behalf, like in a custodial manner, right? That's what's going on there. It's both, it's an asset and a liability. There's probably a more straightforward explanation than that, but that makes sense to me. Okay. Long-term debt looks fine. It's gone up a little bit over the last 10 years, but not, drastically. 2.7 billion of debt, 2.4 billion of cash. Looks great. It's not highly leveraged. No red flags there. Let's take a look at the valuation. So we are comparing to the financial sector. One thing to keep in mind, insurance is in the financials sector. Insurance companies usually have low multiples. Oftentimes, insurance companies are single-digit price earnings multiples. Okay. So yes, of course, it would grade poorly on most metrics there. Price sales ratio, very absurd. Price earnings growth is very high, not too out of touch with the current or the 5-year averages. The valuation is lower than it has been. Across most metrics, it's lower than it has been over the last 5 years. So the dividend yield, 4.5%. You see it here, free cash flow, 4.5%. So they pay out. They're not. They will buy back shares. It'll be really interesting to see what happens next year when they actually buy back shares and what their annual dividend will be. It does appear that their yield in the upcoming year might be a little lower than it is this year. I would not be surprised to see that. However, they are returning all free cash flow to shareholders. Okay. Dividend yield, pretty good, minus the peak COVID and prior to peak COVID years. Dividend yield looks very fair. If you would have purchased this stock at IPO, your yield on cost would be 121%. That's right. You would be making all of your money back into your pocket every single year, plus 20%. We see that reflected here in the fact that their very first dividend was 9 cents, and they're now paying $1.15 in the regular and $5.80. So what is that? 100x in that time frame. This is an income stock, and seeing as though I am an income investor, I like it, right? I like it. Now, you'll notice here, it hasn't performed very well in terms of the price return. Let's look. over the last year. It's underperformed year to date versus the S&P 500. Underperformed over 3 years. It has crushed the market though since IPO in terms of the price return. If we look at the total return, however, also very strongly underperforming over 5 years. Crushing the market over 10 years. Crushing the market over 30 years and didn't even start trading until 7 years into that time frame. So, yeah, on a total return basis, looks fine. So, okay, here's the deal. I think today was payday. Yeah, today was payday for the annual dividend, by the way. So, very, very interesting stock, right? You're investing in a toll booth that is monetizing derivative volumes, right? It's been a very strong performer over time. There's very, very strong cash returns from this investment. You have the underlying growth of the regular dividend, which again, looks like we're almost due for a raise on that. Even the regular dividend, pretty good. 2% yield, not bad, right? The majority is coming from the special. Majority of the dividend growth underlying the name has come from the annual dividend. Very, very strong income stock, okay? So let's talk about some of the risks here. Competitive exchanges. We're going to take a look at this. FMX, the FMX Futures Exchange is a competitor, potential competitor. It's a newly launched exchange. This is a press release dated September 24th, 2024. The BGC Group and 10 of the world's leading investment banks announced a successful launch. It's open for trading SOFR futures. So this is interest rate futures, obvious competitor to CME. Has 225 billion of interest rate swap collateral securing its interest rate swaps. One thing we will do is look up BGC. Here's BGC. This is investment banking and brokerage, also in financials, also a buy. Very poor performer over time. Much smaller company, 4.5 billion. What I do want to talk about is backstopped by Michael Miller's analysis on the moat. I think it's clear to see that volume and liquidity are the main differentiating factor. For an exchange like this to take significant market share would take a long time. They talk about the moat being related to successful execution of a contract, of a trade, far above the spread or the fee or whatever that they're charging. So can I clearly articulate how much of a competitive threat this is to CME? Not easily. Okay. However, I am not concerned by it. I am not concerned by it. If you are concerned by the competitive threat introduced by FMX, then I urge you to pay close attention to the volumes of FMX, probably reported by BGC, not sure, and the volumes of CME Group relating to interest rate futures. So because their margins are so good, because they're so integral to the system, of course, when a company has such a strong moat, competitors want to come into the marketplace and take market share. So that is a threat, but is it a viable threat? That remains to be seen. Okay. What's another risk for a financial exchange? I'm totally going to butcher this explanation, and it's going to be very smooth-brained and very simple-minded. So For those that are more knowledgeable on the matter, I welcome you to enlighten me, enlighten my viewers. The next thing I could think of in terms of risk is that an exchange being something that makes a market or brings a buyer and a seller into a marketplace to execute this contract. The exchange is somewhat of the being the facilitator of that contract. They are the fiduciary of that contract, right? So there is some like liquidity risk, right, with any exchange. You see this with crypto exchanges that end up, losing a bunch of money for people who are holding their assets on them, stuff like that. As an example, where there's assets being exchanged. Well, exchanges. This is where it's going to get iffy for me. Exchanges are kind of like banks in a certain way, where in theory, if everybody goes to withdraw the value that they have, again, even though the exchange isn't necessarily holding the asset, maybe they are, maybe they're not. We see from their balance sheet that they're holding something. If everybody goes to settle at one time, in theory, and there's not enough liquidity there, it's not good. Again, is that a realistic risk with this exchange? No, I wouldn't say so, but maybe just know what you're buying when you invest in an exchange, right? You're investing in the house, and sometimes the house is the last line of defense from really bad things happening. That being said, in theory, a company like this should be benefiting from volatility, not suffering from it, because they're providing the product that allows investors in the marketplace to speculate on the volatility or hedge the volatility. So, again, what I just articulated, probably not very clear, right? Probably not very short, very straightforward, probably not even a realistic risk, but something to keep in mind, something to contemplate, and something to evaluate for yourself. I think another thing here, in theory, the cash flows of the company should be, not cyclical. I think we should look up this for ourselves. Yeah, we did see in periods of market weakness that revenues did go down. So maybe the volume of contracts that they've traded went up, benefiting from the volatility, but the prices of the underlying assets maybe negatively impacted their earnings. So, yeah, that's pretty fair, right? That the company is not immune to market risks. In fact, it might be more volatile in a broad-based market drawdown. We see price. So we see here the company was $141 a share in December 2007. Drew all the way down to $34 a share. That's like 80%. It did not recover to the $141 a share level for 10. And the COVID crash, it went from 213 to 150. That's not bad. 25% went down further. Here we went from 247 to 170. Looks like a pretty volatile stock to me. Okay. In the last bear market environment, 2022 interest rate shock, inflation shock, right? Company did not do well in terms of their price return, and it has not recovered. It has recovered, but it has not performed near to what the broader market has on a total return basis. Or excuse me, price return basis. On a total return basis, it's done fine, still underperformed. So again, what you are investing in when it comes to this stock, it's an income stock. Usually with income stocks, though, they're supposed to be less volatile than the market, or usually they're less volatile than the market. This, however, is not. So the price has severely underperformed the market. I've analyzed quite a few stocks and don't really have any heartburn over that, but you might. So yeah, the main risk is it's an exchange. Know the unique risks that come with investing in exchanges. And then there's some new competitive threats which might weigh on the stock price. However, I don't think that they're legitimate. And then you have really the, I think, true beta risk, we'll call it, in that it's just kind of been the price has been volatile. It has not traded defensively in, you know, poor market environments, given that its earnings are, you know, coming from the markets themselves. Therefore, volatility in the markets, while it may increase the relevance of the company, it does appear to, have damaged their earnings, or potentially stagnated them in the past. So those are the main risks. Do I think that it's a buy, sell, or a hold? I really like the company. I own shares of it. Do I think it's a buy at the current price? Seeking Alpha Quant does. The valuation, again, compared to the sector, not great. I think comparatively to itself, the valuation is good, very fair. In fact, I think we need to. That's not what I want. Let's look at the price. PE over time. Looks like it's been a pretty good deal. Kind of traded along with historical averages the last 2.5 years. Looks pretty good. The price earnings ratio certainly looks fair compared to history. We looked at the dividend yield. The dividend yield looks good. I think the balance sheet looks healthy. For income investors, the cash flows that this company presents to you are good, compelling. I think it's a buy. Um, the thing that I'm mainly concerned about, if I'm a buyer here, is just the way the chart looks, and I'll illustrate that here. We've got this long-term trend here. I've kind of been trading along that. Okay. It will be interesting to kind of monitor price here, but what's going on here is we've been in this channel here very clearly along this channel. Every time we've bounced along this trend line here, we've done a decent job of recovering all the way, and kind of at least 2 times in a row found this point here. So is it conceivable to think that we're kind of in just a week here of, relative weakness? I don't know. But one thing, we kind of failed right here. You see here, we failed, came back down, hit here. The chart just doesn't look super bullish right here. And most recently, we really failed. We failed to hit new all-time highs before coming back down to where we're at now. So is that enough of a concern? If I have a really long-term outlook, do I feel okay buying here? I do. If I'm just trying to scalp, there's no clear entry point here, at least to me, to my simple-minded brain, technically speaking. So, yeah, I think it's a phenomenal company to own, and it's good for income. I think it has a growth element as well, a highly scalable capital light business that doesn't require a bunch of capital to continue growing. Therefore, it can continue to return capital to shareholders. I don't have a lot of financial stocks in my portfolio, and this is one of the more income oriented one that still has growth elements, so I like it for those reasons. So it's definitely a buy for my portfolio. I've bought it in the past. I've added more to it recently. I don't think that where it's at now is a super strong looking entry point, but there's nothing to lead me to believe that it isn't either. It doesn't look super bullish, and it's kind of at a local high, and it's been a little weak as of late, but not enough to really concern me. And the yield is strong. I just think in terms of the actual cash flow that you're getting back to, that's up and down on a yearly basis, but it's been a very, very strong income stock, and see no reason to believe that that won't continue into the future. So, yeah, I think it's a buy. I don't It looks fairly valued compared to history. It doesn't look undervalued to me. And having this stock in your portfolio does allow you to compound your income quicker, potentially, which is quicker than just owning the index, for example. So for those reasons, it's attractive, and I graded a buy. But not a whole lot of strong conclusions to draw from the technical analysis. So that's going to be it for the video. If you found this interesting, consider liking the video, subscribing to the channel, and also following me on Seeking Alpha, where I regularly upload articles and analysis in written format as well. So I've really enjoyed this. Hopefully you have too. Feel free to leave me a comment and interact with me. Love to hear from my viewers, as always. And yeah, hope to hear from you soon on this. It's been a good time. Otherwise, I will be seeing you with the next one that I make. Thank you for watching. All right. See you later. Bye.